Annette Thau, by Annette Thau. The Bond Book, everything investors need to know about Treasuries, Municipals, GNMAs, Corporates, ZE, second edition, hardcover. Get ready to discover the fascinating world of bonds with Annette Thau's comprehensive guide, The Bond Book. This highly informative book provides a detailed yet digestible understanding of bonds, which are simply a debt written as a promise to repay borrowed money. Delve into the complex process of bond issuance, which involves a myriad of players like investment banks, lawyers, and other entities. The book's summary will cover essential terminologies and concepts involving various types of bonds, such as treasuries, municipals, and corporates, while also shedding light on the intricacies of the bond market and the challenges faced by individual investors. Embark on this bond journey that will uncover the inherent risks and strategies for managing investments while providing crucial insights into navigating the ever-evolving bond market.
Understanding bonds. A bond is a written promise to repay borrowed money with interest. They are issued by governments, companies, and entities to raise capital. The bond market is not centralized, and bonds are bought and sold by investment banks in groups called syndicates. Syndicates offer to buy bonds at a stipulated price, and the winner resells them to investors. The borrower pays the investors their interest, and a fiduciary agent handles distribution. Although simple, the process of issuing a bond involves investment banks, lawyers, and other entities. Key bond terminologies: indenture, prospectus, official statement, treasuries, corporates, and municipals are some of the essential terms that bond investors need to know. If you're planning to invest in bonds, understanding the critical terminologies is key to making informed decisions. These include the indenture, which is a legal agreement outlining payment dates, redemption terms, and other crucial particulars between the bond issuer and buyer. A prospectus provides a brief overview of the most essential points in the indenture. The official statement refers to the prospectus after the bond is sold. Treasuries are bonds issued by the U.S. government or its agencies. Corporates are bonds issued by corporations, while municipals are bonds issued by cities, states, and other local government units. Knowing these terms can help you navigate the complex world of bond investing. Understanding bonds. The bond market is complex, comprising bonds from various institutions, agencies, and companies worldwide. Although individuals can invest in bonds, they lack the necessary capital, information, and mathematical skills to trade them successfully. Bonds differ significantly from stocks, as dealers offer varying prices, unlike publicly available stock prices. Therefore, bond investors require a relationship with trustworthy brokers or intermediaries. The Internet has facilitated bond trading, but online exchanges are not prevalent. An investor should understand a bond's duration, which determines its level of volatility. The financial press offers inadequate information on bonds. A novice investor should consider investing between 40 to 60% of their assets in stocks, with the remainder in bonds and cash. The best combination of risk and return for risk-averse investors are 2 to 5 year treasuries and 5 to 10 year munis. Understanding bond trading terms. Bonds explained, key terms and definitions. Bonds are financial instruments that investors use in capital markets as an investment vehicle. But understanding the terms traders use when buying or selling bonds is crucial to truly understand the bond market. In this book, you'll discover the definition of bond terms like coupon, accrued interest, CUSIP number, duration, and more. The terms you'll come across in bond trading include par, which is what a bond is worth when it matures and usually set at $1,000. Knowing how discount and premium relate to bonds is also important. Bonds that sell below the set par value sell at a discount, while those that sell higher than $1,000 sell at a premium. As you start trading or investing in bonds, take note of the difference between bid and ask price, which is what you will receive or pay, respectively. Dealers earn commission or spread from the difference between the two. Coupon refers to a bond's interest rate, while yield to call is the yield earned if the bond issuer pays the bond before maturity. Duration describes how a bond's price will move when interest rates shift. The longer the duration, the more the bond price will change. Finally, the total return is the sum of interest and principal gains or losses. By grasping the definitions of these terms, you'll be able to navigate the bond market with confidence and make informed trading decisions. Risks and rewards in bond investing. Bond investors face two major risks: default and interest rate risk. To gauge default risk, investors can consult credit ratings, watch bond yields, and avoid junk bonds. As for interest rate risk, bonds paying fixed rates face fluctuations in value, depending on prevailing interest rates. Despite these risks, bond investing remains a prudent move, especially for older investors, as it offers an opportunity to compound profits over time. Understanding bond yields. Bond yields have three important measures: coupon yield, current yield, and yield to maturity, YTM. While coupon yield is simply the bond's coupon rate, current yield is the bond's coupon payment divided by its price. YTM, however, is a percentage that expresses the total earnings you will receive over the life of the bond. Reinvesting coupon payments can lead to compound interest earnings and more than the bond's face value. Knowing these measures can help in making sound investment decisions. Investing in bonds. Investing in bonds can be an excellent strategy for those wanting low-risk returns. The U.S. government sells various bonds with different maturities, including bills, notes, and bonds. Treasury notes with maturities under 5 years are a reliable option for those who want to limit interest rate risk. In times of economic recession, Treasury bonds tend to perform better than other bonds. To avoid commissions, investors can directly buy Treasuries from the Federal Reserve Bank or use Treasury Direct, which is an economical and efficient program. Inflation-indexed bonds or TIPS protect investments against inflation damage. Zero-coupon bonds, municipal bonds, and bond mutual funds are other bond variations investors may consider. Before investing, it is essential to research the risks and returns of each bond variation and to read the prospectus carefully.
In conclusion, the Bond Book by Annette Thau is an invaluable resource for novice and seasoned investors, alike looking to understand the intricacies of bonds and the bond market. From elucidating crucial bond terms to insights into government-issued bonds and investing strategies to manage risk, Thau offers a comprehensive guide for an in-depth understanding of this investment instrument. Troubled with understanding the complexity of the bond market? Thau's book dispels the myths and secrecy surrounding this lucrative yet complicated area of investment. Harness the potential of bonds as part of your financial portfolio with this comprehensive book that lays it all down, keeping financial history in perspective and providing practical advice for all levels of investors.